Hello, I'm Richard Cassube, and this is my screen capture presentation of case study Rayovac Corporation, International Growth and Diversification through Acquisitions for STMG 595, Advanced Organizational Management. Rayovac has been mostly associated with low-cost batteries. Their primary competitors are companies like Duracell, Energizer, and Panasonic. In 1996, Rayovac was purchased by private equity firm Thomas H. Lee Partners, THL. THL set out to revive the Rayovac name and expand its footprint through acquisitions and diversifying their product line. They set forth on a 5 to 6 year schedule to acquire complementary companies that could both enhance their current product line and achieve a global market diversification. Rayovac was transformed from a single product line battery company to a multifaceted company that produced more than just batteries. They expanded North American footprint and became a global entity through various acquisitions to increase their market share and overall company value. Their first steps would bring on manufacturing and distribution centers in Germany, Latin America, and China. Their first acquisition would prove to be difficult. The Miami-based ROV Limited acquisition would provide short-term gains through increased revenues in Latin America by 5 times. Unfortunately, an economic downturn would lower sales and increase delinquent accounts and ultimately lead to process rationalizations and staff reductions. Rayovac then purchased Varta AG out of Germany in 2002. Varta was a market leader for batteries in Germany and Austria and the second leading producer in all of Europe. This acquisition was a generous geographical complement as Rayovac's revenues in North America were 73%, while Varta's European revenues were 86%. The companies would soon begin to identify ways to lower costs by eliminating redundancies to the tune of $30 million to $40 million. The next acquisition would be the first of 2004. Ningbo Baowang was a major exporter of private label batteries in China. This purchase opened the door into the rapidly growing Asia market. Ningbo Baowang would be beneficial for their low-cost manufacturing capabilities and also to export Rayovac and Varta brands. Rayovac also replaced the Chinese management teams with their own for improved process and operational efficiencies. In an effort to greatly increase their capacity, they also installed new manufacturing equipment to produce over 1 billion Rayovac brand batteries in 2005. Microlite SA had its problems in high rate debt, but gave Rayovac a 50% market share in Latin America's largest consumer market. Rayovac mitigated the debt through low-cost loans and recapitalized to make Microlite SA a worthwhile purchase. Rayovac also replaced the management team in Brazil to identify ways to lower cost, increase efficiencies, and improve packaging. Remington would prove to be a very beneficial acquisition for Rayovac. They already had facilities located in China that enabled collaboration between the companies for manufacturing and distribution. Rayovac could leverage their presence in Europe to expand the Remington product line outside of North America and into Europe and even Asia. The acquisition created synergies for increased growth and overall net income. The next two acquisitions would take Rayovac far away from their core competency that batteries would no longer be their number one product line. United Industries enabled entry into 2 markets with 1 purchase, lawn and garden and pet supplies. Rayovac could take advantage of the solid lawn and garden market as well as the quickly growing pet supplies market. United Industries also gave Rayovac stronger ties with Walmart, Lowe's, Petco, and other major retailers. The acquisition of Tetra moved Rayovac farther away from core competency and made them the largest pet supplies company in the world. It would come at a price though. It almost tripled Rayovac's long-term debt from $806 million in 2004 to $2.298 million in 2005. The Tetra's purchase lowered the percentage of total sales in batteries from 65% to 35%. Even though their opinions about the steps Rayovac took to grow and diversified, they made their stockholders happy, growing shares from $15 a share to over $45 a share from 1996 to 2005. It wasn't a fluke or luck, but really 2 growth concepts: market advancement and market intelligence. The acquisitions of Varta, ROV, Microlite, and Ningbo Baowang advanced Rayovac's market share in the battery industry and enabled cost savings through consolidation of operations and administrative functions. The Remington acquisition was somewhat of a hybrid in that Remington assets could be combined and utilized with Rayovac's, advancing the product lines for both manufacturing and solid sales entry points. The market intelligence for Remington gave Rayovac the number 2 spot in the U.S. for personal care products, with a steady year-over-year growth of 3%. Finally, the acquisitions of both United Industries and Tetra were based on market intelligence, showing strong demand for pet products and broad opportunities in the lawn and garden demographics. The result had been continued brand support and favorable stock prices. While not everyone is a fan of the path Rayovac has traveled, their board of directors, shareholders, and employees have seen significant returns on their investments and continue to see that today.